back to the Monetary Policy Special. I've been speaking with SBI Chairman Dinesh Khara, Samiran Chakraborty of Citi, Prasanna of ICICI Bank, and Mridul, Saggar, former ED of Reserve Bank and now Professor at IIM Kozhikode. Gentlemen, thank you very much for your patience. You know, one of the things that stood out for me is the governor already in Davos putting on the table the 7% growth expectation, and now it is formally the Reserve Bank's forecast. Samiran, is the Reserve Bank being way too, optimistic? Somanathan, when he spoke to me after the budget, said that he's not betting on 7. So this is a very unusual case of a central banker who's supposed to be conservative being more optimistic. Would you agree?
So, as of now, the high-frequency data that we are getting doesn't seem to indicate that the growth momentum is at all slowing down. But there is a narrative that is building up that global growth is going to come off sometime in the latter part of the year because of maybe US recession. There is a narrative that in the budget, by putting the fiscal deficit target at 5.1, the fiscal impulse is going to be negative. And then on top of it, the consumer side of the economy is softening, etc. So all those narratives, people are trying to build that into a lower growth forecast for FY25. We are at 6.5. But if I purely go by what we are witnessing now, there is nothing to suggest that the growth momentum has significantly weakened. So RBI probably banking more on the current growth momentum, and we'll wait and watch to see how the other developments shape up.
You know, about 10, 12 months ago, Reserve Bank was the only one calling for 6.5% in FY24. Everybody else was 6 or sub 6, and they had the last laugh. I mean, it's 7.3 now. Two questions to you, Mridul. First, you agree that this 7 is not optimistic and kind of indicated by lead indicators? I'll come to the second question in a minute.
Okay, so 7 is not quite optimistic in the sense at the margin one can say so, because my own reading was something like 6.8 as a base case, which is not very different from 7. Having said that, where I differ from the Reserve Bank assessment is that the risks are on the balance around that estimate. Actually, if one sees, the risks are more on the downside, and the risks would play out if we have another global disruption in some form, and that is where the growth can fall. So 7 is good. I mean, we have good PMIs. The service PMI was a rocking number this time. If you look at the investment, the capacity utilization rates are marginally above the long-term averages. The investment cycle is not kicking, but it's neither bad. I mean, on the number which they released with this policy, it is like 40 basis point fall. But if you up. But if you see a seasonally adjusted number, it's a 70 basis point dip. But that's still marginally above the long run average. So I'm not too concerned about investment. Cycle can kick off if global conditions, economic environment, the political environment improves.
Mridul, I have to hurry up. Mridul, I have to hurry because I have another question to give you, and some more to ask the chairman as well. You know, this inflation and this likelihood of the stance changing late. Already, Jayant Verma has voted against both the status quo policy as well as the stance. I mean, he's obviously asking for a cut. It's possible that others will join in as you start getting the, April-May numbers where the inflation may go closer to 4.5%. In that case, do you think they'll be pressured if 2 people vote for a rate cut to be giving the rate cut earlier?
There would obviously be some pressure at the margin, but I think here there is a central bank wanting to establish a credibility that they will push the inflation down to 4%. Let us see how it plays out as things go around.
No, otherwise I think Samiran's guess makes sense, because it's only by October you will know that there is a sub 4 number, and therefore a rate cut seems logical. Prasanna, how do you see yields? do you see for the full year, the 10-year itself, or if you want, up until June, and currency, anything that we should be prepared for in terms of a range, any appreciation?
So I think, Lata, to predict yields for a longer duration seems like a little easier right now. I can possibly say it'll touch somewhere between 675, close to 675 for sure, when the bond inflow happens and when the rate cut cycle actually starts. But I think the more difficult thing is to figure out what's going to happen immediately, because the thing that I wanted to say is while explicit change in stance would have given a lot more comfort to the market, now, the way RBI is giving the comfort is saying that I'll take care of liquidity by doing VRR and VRRR, which means a lot of it is going to be left to the actual execution on the table by Reserve Bank. And that means that the market is always going to be left on tender hooks, whether the RBI gives enough liquidity through the VRR route to ensure that the system liquidity deficit is taken care of for the fortnight. And so, for example, the 250,000 crores of 14-day VRR, which is maturing tomorrow, RBI has just now announced a rollover of only 175,000 crores. So it's quite possible that tomorrow we'll again see, call rates inching up, and so GSEC also a little bit reacting to that. So the long story short is, over the medium term in this calendar year, we are comfortable that there will be a rate cut. Maybe you can quibble about whether it's in August or in October, but in the immediate short term, now we have to see whether RBI's comfort of trying to bring weighted average call rate to 6.5, actually they are able to execute properly on that.
Fair point. Whether they behave like they did in the last 10 days or whether they behave like they did in the last 5 months, that is going to be a problem. Well, very quickly, Samiran, as briefly as you can, do you think the Reserve Bank is wantonly keeping this, keeping the market on tenter hooks because growth is so aggressive? They don't want to give a free hand to the risk takers.
I suspect the reason is more from the financial stability side.
Okay.
And that's a somewhat vexed problem. But prolonged period of easy liquidity has fed into some financial stability issues. And that's why they want to keep liquidity tight for a while longer to see that this does not distort things in the short term.
Yeah, there is some fear that maybe that's fueling the equity markets as well. So perhaps that's working on their mind and they want to keep bankers and borrowers guessing. Mr. Khara, thank you very much for your patience, but I hope you realize that the press conference was actually hijacked by the Paytm issue. Now, the governor and the deputy governor both said that the actions were commensurate with the lack of compliance. That's a strong statement. Now, if that is the level of non-compliance in that payment bank, do you think this payment bank will have a problem continuing its relationship with other banks like yours? Will the banks become scared to continue their relationship?
I would respond it like that. Anybody who would be looking at it would also be ensuring that what is the likely compliance burden. So that compliance burden cannot be ignored. So, and for that, there has to be a very clear assessment in terms of what are the compliance gaps. So that's how I did the thing.
Oh, okay. Well, that is important words coming in from the chairman of SBI on how banks may think about their alliances with Paytm Payments Bank. But on the main monetary policy, the expectation is that the rate hike is likely pushed out. The hopes are pushed out. And on the immediate liquidity, it looks like the RBI will give it. But again, that's not 100%. That's the main takeaway from our guest. But growth very strong. That's something which my experts are also agreeing with the Reserve Bank. On that note, it's a wrap on this special broadcast. Samiran, Prasanna, Mridul and Mr. Khara, thank you very much for joining us.